Ed Ponsi of Barchetta Capital Management is here to weigh in on Apple stock a day after Tim Cook said that David Einhorn's quest for shareholder value was a sideshow. Now, Ed, is this something that a CEO of a company that is this closely watched should be saying?
That might have been a bit strong to say, call it a sideshow. But in the end, I do agree with Cook, because if you think about what he could do and what Apple can do with this tremendous pile of cash they're sitting on, sure, the shareholders would like to have that. But think about all the ways that Apple can leverage the advantage that they already have and the technology that they already have, and just leverage that by using that cash pile through R&D, through takeovers, a variety of ways. So frankly, I think the company's better off keeping the cash than giving it back to shareholders. I think that's what Cook meant when he said that the company does not have a depression mentality.
So he's not necessarily saying that he doesn't care about the stock price. But let's talk about the stock price, because it has come down significantly. Now, is this due to sentiment in the name, or is it because they don't have any major near-term product catalysts?
Okay, great point. Now, here's what I'd like to say about that. The stock is up nearly 500% in the last 4 years, even after its recent pullback. So as far as returning shareholder value, I'd say the shareholders are getting their money's worth. If you've been holding Apple for the past 4 years, you've got it underneath $100 a share. The fact that it's come down from $700 is only telling me that the stock got ahead of itself. The stock actually went parabolic last year, basically started to go straight up. That's not a good thing technically. And what happens is, basically, here we are at Valentine's Day, right? This is going to be the first Valentine's Day in a couple years that not everybody loves Apple. Not everybody is in love with it. I think that's good. I think too much love can be a bad thing on Wall Street.
Yeah, it certainly can be. So, but what's the trade here? I mean, from a short-term perspective, I could see maybe this being a trade, but can you own it long-term?
First of all, Apple has always been a fundamental buy. Now more than ever, you look at the valuation, 11 times earnings, a PEG ratio of only 0.56. That's ridiculously cheap. Plus, you're sitting on this gigantic pile of cash. So fundamentally, it's always been a buy. There's never been a point over the last 4 or 5 years that it hasn't been a buy fundamentally. Technically, it got ahead of itself. In order to get back on track again, the stock has to get back up above $500 and back up above its 50-day moving average. That has capped the stock since October. And if Apple can break above 50, that's going to kick in some buy programs. I know a lot of traders will start buying the stock if it can get above its 50-day moving average. That's the key right now, technically, for a short-term trade. But for the long term, Apple's always been a buy, and it's a great value right now.
All right, well, there you have it. If Apple gets above that $500 mark, it's definitely a buy. Though if you are a long-term looker, if you're looking for long-term value, you can buy it now. Be sure to follow Ed Ponsi on Real Money Pro.